To you, Jeff.
Thank you very much, Mike, and it's good to see you again. I like wherever you are. It must be quite warm there. Mike, as you rightly put it, ESG is very big for us. As John has said, it's about sustainability. This company is going to be there in the future. It also strengthens governance and just social good and doing good business among the communities and your stakeholders. So what we've done is that we have now developed draft ESG guidelines that are supposed to help companies really comply with ESG requirements. And we've put this out for exposure, and there's very soon there are going to be formal guidelines for listed companies. We want to see more and more companies embrace ESG because we've seen good results out of it. Companies that are adopting ESG are doing much, much better. They're performing better. Their governance structures are better. Their response to their stakeholders and investors are better. And investors are actually looking for these sort of companies in the stock exchange. And that's why you see about all our companies are now embracing integrated reporting, and also some are doing sustainable reporting. So I think it's getting traction. This is becoming a check for every new investor who wants to come in. And I'm glad to say that all this knowledge is now coming through. Still a lot of training required, a lot of issues. Many are concerned about costs, but that's why we came up with guidelines to just begin the journey and help these firms comply. So that's going to be big for us. And for us, corporate governance is critical because we've seen that has been one of the biggest weaknesses in the past on the exchange. On the use of AI and all these new technologies, we are not asleep. We are awake to the reality that these are technologies of the future. But anything that we embrace has got to have a very clear angle around ensuring that it's environment friendly and responds to our bigger sustainability agenda. We have got a very big issue. We're very big on ethics and how to control that, and so we respond to that. So just to say that it's a reality. NSE is a very innovative exchange, and we will adopt these emerging changes as they come through.
Thanks, Jeff. And so we pivot back to banking a little bit, and two questions that kind of interlink. And one is the proposal to have risk-based lending. Is that suitable for Kenya and perhaps the region? And then Purity is asking, piggybacking on the interest rates, there was a discussion on lifting the cap. Now the young people feel pushed out of the mortgages. How are the banks alleviating the stress on the young people, especially on the back of impact of COVID and jobs, etc.?
Yes, so on risk-based lending, I think the question is whether it's suitable for Kenya.
Yeah.
So perhaps maybe if you allow me, let me just say a little bit about that, because I find there is a bit of misunderstanding or misconception about risk-based lending and what the conversations we're having with the central bank. Most banks today exercise some form of risk-based lending. I think if you look at companies, large companies, what they pay to borrow money is very different from what a small SME will pay to borrow money. And even within SMEs, there's still risk-based, based on relationship, and I hate to say negotiation power sometimes, and other things. So we do a lot of risk-based pricing even today. The conversations that perhaps is in people's minds and the newspapers is a conversation we're having with the central bank, which is to say, the fact that we do, but there's such misconception and misunderstanding, is there something we can do to make it easier, simpler, and more visible to everybody? Can we get to a point where Irene can say, based on my CRB score, my Credit Reference Bureau score, this is what I expect to be charged from an interest rate from a bank? That's where we are trying to get to. It doesn't mean we don't do that today. We actually do. It just, there are many other things that go into that models, and each bank has a different model for that matter, and is not visible to customers, but it's there. So do I think it's suitable? Absolutely. The form it will take, I don't think we'll get to a level where it's so visible to the customer, but we'll get to a level where a customer can determine whether they're an elevated risk or they're low risk. And based on that, they can then negotiate with the bank for the right rate. Now, I don't want to preempt what the central bank will agree with the various banks, because these are individual bank to central bank conversations. But I think that there is need to give a level of visibility at whatever depth to customers to move away from this perception that there's no risk-based pricing. And that really then goes very well to the second question about mortgages. I'm surprised that people would say they're not getting mortgages because of pricing. I want to say it has nothing to do with pricing. I saw a bank that recently announced they're doing mortgages at, I believe, 11.25%. Our own bank does mortgages at 13% with 105% financing. We finance even the costs to acquire that home. So young people should not feel that they are pushed out from getting mortgages. They should go to their bank, ask about the product they offer, the mortgage product they offer, and explain how they're going to pay for the mortgage. You know, banks look at two things when they lend. One, we look at your ability to pay, and that is really simple, is your cash flows. If you have a job, it's your salary. I mean, it's really simple math to determine that. But the harder part is the willingness to pay. So that's the other thing we assess. And willingness to pay is very simple. If you've gotten listed on CRB for not paying a loan, already that elevates the risk that you're not willing to pay. So even if you come show me you have the money, the fact that you're listed on CRB tells me, yes, you have the money, but you're not willing to pay. So those are some of the things I would tell young people. Don't get yourself listed, because the moment you do, it dents your willingness to pay score, which is very important input to a credit decision.
And then there is a question. Why big names or companies and banks have fallen in the last few years? Is it because of weaknesses in their management, or is it market related? We've seen so many of these, we can mention names, but they come to mind easily. How do we give foreign investors confidence when so many of our companies get to a certain level and you think they're about to take off, and then instead they just tank? How do we redeem ourselves and make the ones that fall a one-off as opposed to the norm?
Well, I think that really speaks to the sustainability term that Michael was using and I used, which is that when you look at companies, one of the biggest input into that sustainability measure is governance. And I would say that the companies that have fallen more recently, I think banks is perhaps the last ones were 2016, so it's a while ago. But even those, you see that the biggest question surrounding those banks was governance. How are decisions made? Do people know what goes on in that bank? Do the people who work there know what goes on in the bank? I have a mantra at NCBA that really nobody should tell you that if you work for NCBA, nobody should ever tell you when you ask a question that that's none of your business, because everything at the NCBA is your business if you work for NCBA. You should understand how it works. And I think that is the openness that we need with these companies. If you look at each of them, you will realize that a small clique of people knew everything that was going on. And the majority of people had no idea. You meet somebody who used to work for those companies, they tell you, I really thought things were great. I always thought, this is how we do things. So that's one. The governance, I think, is very, very important. The other thing that on governance, I would say, is a lot of our companies in Kenya are family owned. And we make the usual mistake of thinking that because I was a founder and I know how to run this business, then my son must know how to run this business just as well. So you find people who have their sons and their daughters working the same business. That's the board. They're everything. And that's a scary position to be. Why? Because one, the founder knows the pain. The sons never know the pain, or the daughters never know the pain. So the spending, the way they approach business, the customer relationships that they have, they may not hold them as keenly as a founder. So it's very important that everybody looks for an independent board members, and also independent management is very, very important at some level. Even if it's the family that's involved, make sure maybe the head of finance is independent. Make sure somebody who knows what's going on is independent. So those things become very, very important for me. I think the companies that have fallen, that to me has been perhaps the biggest problem I have seen.
Would you then say that we are getting our act together, or should we always be afraid that someone else is going to fall? Do we have the systems in place to make sure that, especially for listed companies, that we have the systems in place to see this coming and maybe stop it before it happens? Are we doing better than we were maybe 4 years ago?
I would say absolutely. Starting with the banking sector, I would say that the regulator has put certain measures that force banks to have better governance. They upped their vetting process for directors, their requirement for directors, and the definition for who is independent and who is not. And they clearly force the decision-making process to be aligned to, now we have the banking charter, aligned to the banking charter, which is very important. I think looking wider for the listed companies, I would say the Capital Markets Authority has done a lot of work in this area. They have put a lot of governance requirements as well, again, on independent directors and decision-making processes, and also the requirement for certain committees to be formed that are purely made of independent directors. I think those are some of the things that they have put in place and will continue to enhance governance. Now, for the privately owned companies, that's a different matter because you can't force them, unfortunately.
Yes, but I guess I'm just
curious. Comment on this? Can I comment on this, Irene, please?
Yeah, no, go ahead. Go ahead, Mike.
Yeah, it's interesting that in banking, they've been doing much better. In insurance, where I'm involved, I'm the chairman of Occidental Insurance, the regulator has not been doing so well. And the AKI, the Association of Kenya Insurers, is not as strong in bringing together the players in the industry as the Bankers Association is. And I was going to ask you, actually, John, about the factors that have led to a strong self-regulating KBA with a good relationship with a strong regulator, the central bank, and what advice you would have for the insurance industry that's very jealous of you.
So that sounds like a trick question, Mike.
No, it isn't. It's very straightforward.
No, I say that knowing the insurance industry, and of course, you know the role brokers play in it, and I think that complicates a lot of the work the regulator has to do. And being on the receiving end of because of a bank assurance business, we don't. The regulator has been very focused on us again, thanks to the work of the brokers. Look, I would say that the insurance business is very, very fragmented, as you know, very, very fragmented. It's also, you say it's not as regulated. I think it's highly regulated in terms of pricing and many other things, especially the latest changes to the Act. I think it's there. However, when it comes to governance, I think that's why it has not necessarily been as well regulated. And I find that a lot of that is determined by the structure of insurance business. And by structure, I say that because of the role that the brokers play and the fact they are they're embedded into the act, they are supported into the act, and there are so many, and they're completely non-regulated in many ways. I think they make it very difficult for insurance industry to really get free regulated. What advice do I give? I think, look, one is that the regulator must be willing to work with the association. That's very important. Must be willing to work with the association. Number two is that the insurance companies must also demonstrate that they're coming together for the benefit of your policyholders. And I think if that is the basis, when we go to a regulator, the basis is what is in it we're doing that's for the benefit of our customers. We don't always agree, but when we start from there, we have very great conversations. When we start from making better profits, those conversations never go anywhere. Or protecting our balance sheets, those conversations never go anywhere. So I would say that's the other, perhaps, reason to. But everything comes together because of a crisis. I think the insurance industry today, if you ask me, they're facing a few challenges. I think the act that was put in place, whereas it was supposed to favor them on cash and carry, I think it's reducing business in my view. So I think soon you'll need to come together because your pie is going to be eaten.
I hope, Mike, that answers your question. So let's get to some tough questions. And by that, I mean, we are looking for some reassurance, John, in the sense that there is COVID now. The economy is somewhat depressed. And then there is the elections coming up. When you look at all of this, and anybody holding on to a job is probably holding on by a thin thread, or economy, or your dukkha somewhere. How do you see this unfolding, and how do we kind of soldier on without feeling overwhelmed?
Look, I think, as I started by saying, it's been a very difficult period for a lot of people, a lot of businesses, a lot of families. And unfortunately, whereas we talked about, last year we were talking about post-COVID, I think we are more and more realizing there's no post-COVID. It is living with COVID and how we're going to live with COVID. I think a couple of bright spots, even as we look at the depressed state we find ourselves in. One is that if you look at the level of vaccination that we have in the country, I think it's going to accelerate very quickly. And I'm glad to see so many people who are looking to get vaccinated. And that will allow for reopening of the economy. I hope so. Obviously, we have seen even in countries where vaccinations are high that there are, variants of this disease do come back. But at least even when they do, it becomes easier to control once people accept the fact that you need to be vaccinated. So I think that's one. Our own estimation for economic growth for this year remains 5.1% on a GDP growth basis, which is a very healthy rate, especially pre-election. So our view is that we'll still grow at that rate. I think the other positive outlook is obviously the work that the government is doing in terms of infrastructure. I think today we will all complain about the traffic. We'll all complain about, money going to China. I hear those complaints all the time. But no country grew without infrastructure. And certainly infrastructure was not done after the countries grew, as some people like to say. Infrastructure is a base that helps the economy grow. I think I'm quite excited that in the near future, we'll be able to have 3 meetings in Nairobi. Today, you can't have 3 meetings in Nairobi. If you do, then you're a magician, because to move from one side of Nairobi to the other, it's impossible. Hopefully, in very near future, we'll be able to do that, and that should help the economy. I would say the other thing is that when I meet people, a lot of people have taken this time to upskill themselves. Yeah, take a new trade, learn something new. Some tell me they've learned programming during this time. some avant music during this time. Once the economy opens, I'm hoping all those talents will come to bear. And once they do, I think you see new businesses coming up very, very quickly that again will help lessen the pain of what we are going through today. So I think there are some positives to look forward to. There are obviously painful period to go through, but as we go through this, what I'll tell everybody is stay alive, because there are bright times coming.
Jeff, I'll ask you the same question then. How do you see this unfolding? How do we navigate all the challenges that we're going through now and come out the other side strong enough to continue fighting, especially with the politics coming up?
I think the most important thing right now is being healthy, and people just making sure that they can keep themselves and their family and friends very healthy. My take is, I believe that people should eat.
We can't hear you well, Jeff.
Oh, sorry. My take is that people should heed the government's advice and really try as much as possible for us to get these vaccinations going so that we can reopen up the economy. And I think Kenya is trying. I mean, we are accepting vaccines from all over the world, and it's important that we consider this. So I think that's important. I think we must prepare for a new world and really live and adapt to it. I think digitization and digitalization will be a reality. We have to embrace that. We have to embrace a new way of life. And today, I was one of those fellows who never imagined people can work from home. I have accepted the reality that it's happening, and we just have to build mechanisms of ensuring that is done. I think companies are remodeling. I'm happy to see companies are changing the way they do their business. Investors have to look at the market possibly that now this is the time to also change your investment style. Don't live in the real world. Don't put away everything and not enjoy today, because we've seen we've lost people who have invested all their money hoping that they'll retire but have not made it through. So it's a balance we have to strike, but I think we'll navigate and we'll come out of it stronger. As Jonas said, I think it's important that we all try to stay alive to enjoy the bright future. Thank you.
Thanks, Jeff. And so back to you, John. Some trends we may never go back to some trends. For instance, this Zoom thing, love it or hate it, I think it's here to stay. And then there are other trends like working from home remotely, even from different countries, and such like scenarios where COVID has forced us to rethink the way we work. How do you see that whole space unfolding? Are we going back to the way things were, or some things like Zoom and Zoom meetings here to stay?
Well, look, I saw somebody asked a question, what I think of working from home, and and I think that's where you're coming from.
Yeah.
Let me first state that I am not a fan of working from home. I'm a strong believer that for companies like ours, that culture matters a great deal, and you cannot build culture through Zoom. It's very difficult. Also, that we're always recruiting new people, often from universities, and those people need to be trained. And I don't see how a new person gets trained fully at home to be a banker without coming to join the culture of the NCBA and to work with the tools and to learn to work with the tools and the people that we have. So I'm very clear that when it's all possible, I want everybody who works for NCBA back at work. So that I've made clear my position as far as working from home is concerned. That said, however, I think there are cases where people will have to work from home. And so I think it will be certainly an accepted way of life, a way of work. There are certain tasks that are truly tasks. There are certain jobs that are truly task orientated, where people are individual contributors. One of these is programming. If I were a programmer, all I need is a computer. And once in a while, I get on Zoom to agree on what we're programming. And then I disappear for a week or 2 weeks as I build whatever we are building. I think those jobs will be done, will become online jobs, and a lot of them will be done at home. It's been funny to meet some of my friends who work in the States. I meet them in Nairobi and they tell me they're still working. And as far as their boss is concerned, they're still wherever they should be in the US working, because they're just saying, I'm working from home. And it's a new future, it's a new reality. So I think certain jobs people will be able to do it. But I still think that long term, first of all, humans are very social mammals. We need that contact. We need that, meeting with people. Culture is a very big determinant on the way we do business. Contact is very important for creativity. There's no way we can be creative if all we do is meet on Zoom. So I do think that as more people become vaccinated, as people feel safer, we'll see a lot of people wanting to go back to where they can spend time with people at work.
Mike Eldon, do you have a position? Do you think we are going back, or Mike looks like he doesn't agree? You're on mute, Mike.
Mike, you're on mute.
Thanks. I've been working from home for a number of years, way before COVID. And for 2 months earlier this year, I was working from my hospital bed. But I can well understand what John is saying about his kind of environment and the importance of culture and creativity and staff development. That's quite uncontroversial. But for me, as a consultant and a director, I go to meetings with my clients, for my board meetings, for strategy retreats, whatever it is. Of course, when I write my articles, I do so from home. So, as John was saying, it's horses for courses. And some people can work at home for a higher proportion of the time. They say that introverts are happier with this, people who get their energy from within and from, dealing with an issue on a screen rather than interacting with a lot of noisy characters. But we are social animals. I am, and I love going out to physical meetings for over a year now. And we've got several people from our Rotary Club of Nairobi on this Zoom here, Beatrice, Irene, Michael Hopkins, maybe others. We've not met physically for over a year. We miss it. And as soon as we can get back to it, we're really looking forward to doing that. So there's nothing that John has said that I disagree with.
Okay, Jeff, before I let you go, then I'll ask you, what's your view on the fact that we seem to have very prominent stocks on the stock market that our investors focus on? And John, you will come back to this because most of those stocks are bank stocks. And so I guess the question we're asking, along with teaching people how to invest, how do we expand so that banks are helping businesses get to a place where they can list, and so that we have a better diversification than just the banking stocks? Because right now it's very limited. If you're going to invest on counters that are said to be doing well, you'll find that it's probably 6 banks and Safaricom and maybe EABL. Talk to that and paint a picture where it looks a little more different.
All right, let me start with the last question. Why do we put a case for companies to raise equity and also debt? There's a symbiotic relationship between that.
Jeff, you're breaking the setting. Have you changed your setting? Okay, John, go first while Jeff sorts out.
Sure. I think you asked what are banks doing, or what should we be doing to help companies list. Let me start by saying that there is an ongoing debate at KEPSA, of which I'm a board member of, about the perception of big business being bad. I mean, in this country, we spend a lot of time talking about SMEs, which are very, very important, and micro SMEs. So we spend all our time talking about those and what we can do to help them. And to the point where it's almost bad to be big business. Yeah. I think we need to change that narrative, that big business is actually good, because big business is what you anchor SMEs. Then the SMEs will be the suppliers, they provide the distribution channel of big business, and so on and so forth. So I think that is an important anecdote to raise here. Following from that then is that if you believe that, then you have to work really hard to continue supporting big business. Banks do everything they can, and they want to support big business, because as I said last time I spoke on this channel, Irene, is we only make money when we lend. I think it's important to note. We make money when we lend, so we do want to lend. And we want to lend to stable, big, safe businesses. So we want them to develop. I think that said, I will also fault the banks for a number of things. One is that because of, I guess, experience, is too many of us banks are asking that everybody must have collateral before they loan money. And by collateral, we mean land. And so we force even big banks to have to buy land so we can take it as collateral, which I think is unfortunate, but it's something that we do. So I'm saying things that I know we do, but I think is wrong, because then it's very difficult to grow, because every time you ask a loan, you ask for collateral. So what you do is you make a little profit, you have to go buy land, so it's available to borrow more money, and so on and so forth. And what happens is that you find to grow a business in Kenya becomes very difficult, because you have to keep buying these other dead assets, if you may. So I would challenge ourselves, and I would challenge banks, and that's a challenge for, I guess, for policymakers to think about ways of better assessment of credit, making it easier to recover, because that's all comes from the recovery problems that we have, making it easier to recover when loans go bad, and therefore finding alternative collateral that we can hold on to. Today, unfortunately, people say take my stock as collateral. I can almost assure you that as business goes bad, the first thing to disappear is stock. And I think you find it's different from developed economies, where you take stock and stock will be there, and and whatever numbers you're shown are correct numbers of stock. I think those are some of the things that we need to change as a culture to help on that question that you asked about growing these large companies to list on the stock exchange.
Then I will ask, Becky had a question, and I'm focusing on Becky because she's representing the younger employees that are kind of joining the workforce. Becky, you had a question the last time we talked. If you could focus on the younger people's space.
Yeah, I think the question was, it was indirectly answered by Geoffrey, because I was asking about, you asked the question about, are we focusing on the right market? Because my question was about inspiring more young people to know that there are different options, not just saving, because most of us probably when we're young, we know you can put something aside on a little piggy bank. Then when you grow older, take it to the bank. But now focusing on educating people, like knowing stocks. Like when I was growing up, I virtually did not know anything. And even after I went to business school, but even after studying, it was still a very abstract concept for me. I've only gotten into investing in the stock market in the last year, to be honest. But now it's something I'm wondering, why didn't I start earlier? I would have a very huge portfolio, because 1,000 here, like this, thinking about the prices of the stocks, it's been mind-boggling for me. It's not that I haven't had money that I would have been putting slowly by slowly in the stock exchange, but now I'm investing a little in Johannesburg Stock Exchange because I'm in South Africa, and I'm investing a little in NC. And it's so I'm just, you know, for the sake of the young generation, I think the question has been partly answered. But I know Bojani in that from a business perspective, but what more can be done at, you know, at a larger scale, like to create really huge public awareness so that someone who's in university can actually be doing that, having that discipline.
John, I think you picked that up because I think we're hopping on this question because there seems to be a gap. She's in business school and only recently started investing. That leaves you wondering, how about those that will probably not go into business school or leave the country or, you know, get the opportunities? How do we get it as a matter of course that people know they have that option even if they opt not to go for it?
Look, I fully understand Rebecca, and also I want to tell you, you're probably starting quite early, which is good. We made the same mistakes, probably a lot worse mistakes, I must say. I recall in university, we used to have an investment club that would meet and we talk about, you know, invest in Microsoft, invest in Apple. Those were very many years ago. I would have been absolutely very rich today, but I did not. So I think, unfortunately, everything connects backwards, as they say. But to your point, I think it has to be about educating them, but more importantly, is forming those investment clubs. I think as you're talking, a penny dropped for me that we don't do a lot supporting those investment clubs. They're usually small clubs set up in universities or by small communities. And us as big business are never anywhere to be seen. I think there's a lot of work to do through those clubs because one, people give courage to each other, they educate each other, and that is the way people start. Individuals, it's very difficult to start when you have, you know, 4,000 shillings and you could use going to Mombasa with your friends and not invest in it. I'm telling you, when you're young, the choice is very simple. Yeah. But when you're in a club, I think you can measure that support.
Okay, and so Jeff, we had called on you to, I'd asked a question. Well, you've heard Rebecca, and maybe you could touch on that. But we were also looking at banking stocks and expanding that selection so that when someone like Becky and other young people like her, when they come to the stock market, then they have a bit more to choose from than just the banks and Safaricom.
I want to quote also Warren Buffett, who say that he started investing at the age of 11, and when he asked, and he said his biggest regret was that he started late. So, so we've all have our breaks. So Rebecca, it's not too late. As long as you've now developed the interest and you've discovered your purpose towards that, I think it's something you'll achieve more. Now, John has a point about aggregation. It's easy. It's a lot easier to invest as a group as opposed to investing individually. You achieve economies of scale. You are able to distribute the risk, and hence you're also able to achieve a lot in terms of even just sharing. So we are encouraging investment clubs. We're encouraging Chamas. We're encouraging people going through unit trusts and etc. is the best way to come to the stock market. We would actually prefer a lot of Kenyans investing through aggregators like unit trusts and all these providers, because that way you're getting professional advice, guidance, and better risk management going through that, as opposed to coming and buying an individual stock of breweries. For instance, you're going to buy 100 shares of breweries, you spend 14,000 shillings, and you take a knock and it really wipes out your entire savings. So aggregation is the trick towards achieving that. I think before the internet stole my thunder, Irene, you were asking about the concentration risk that we have in the market. I don't call it as a concentration risk. It's not a concentration risk. I think we have got successful companies. We would like to see more banks, more Safaricom. When you have big boys, that attracts big boys. In this market, we say liquidity attracts liquidity. So if you're going to be a small market, you will never attract a big player. ask yourself, why did Bank of Kigali come to Kenya? It's because we have big companies. We have a lot of investors coming through. We have what we call market depth, because they're sure that trading will happen. And today they're not disappointed. I mean, the share is trading at 40 shillings, and they're very happy about it. So big companies are very important, and that's why we are very happy with seeing these companies growing. We are going to be targeting more of them, and even a small company can become a big company. Okay, so okay. I think let's not think there's a concentration risk. It is that we have successful cases, and happy to see people coming through. Yeah. Cutting short, because this thing might take the thunder away from me again. We are doing turnovers of between 500 to 1 billion shillings a day. Where is that coming from? Investors. So if the market is active, only that it's active in a few hands. So if you want to be part of the party, this is the time to come in. Let's not wait and say there's never going to be a better time. Okay, so take your leap of faith and come to the market. And I think
what's that number again? What's that number again? The turnover?
About 1 billion. We're doing about 1 billion shillings a day on average. Oh, wow. Which is mainly international, but we believe the retail can also come in, and we're looking forward to that. Sorry, guys, my internet might drop. Mike will catch up, I believe, at some point when all these issues go down and forge the sustainability agenda.
Thank you, Jeff. We'll look forward to your session in the coming weeks. So we'll excuse you for now. Thank you. Thank you so much.
Thank you, Jeff.
And so, John, then let's go to NCBA and the future of NCBA, and perhaps even where the heart of Kenya Bankers Association. Are we going back to brick and mortar, or are we going to digital and just doing things from home? Because I saw there was an announcement that you were expanding branches. Walk us through that.
Yep. So as NCBA, so let me start with the industry first, and then I'll go to NCBA. Yes. As Jeff said, the future is digital, and given COVID, we have seen very strong uptake of our digital channels. And I think today, I'm sure people on this panel, if I ask them the last time they were at a bank branch, they probably don't remember. But that speaks to service. As far as service is concerned, that will be on the palm of the hand. That's where we are going forward. However, when we did a survey to ask people, what makes you open a bank account? The number one reason was accessibility to an outlet. And interesting enough, what you find, for example, is a lot of university students, say at Kenyatta University, will have their accounts with Co-op or Equity because there are branches there. And across, even in a place like Nairobi, where there are so many banks, people will still say, if I don't know where your branch is, I cannot open an account with you. So that speaks not to our story. We are, depending on the day, the third or fourth largest bank in the country. We need to be relevant to this economy. We need to be able to bank Kenyans no matter where they are. We are known for asset finance, and we have financed vehicles from, anywhere from Tana River to Mandera. And those customers keep asking, when are you coming to where we are? So that we stop this thing of sending you a check in Nairobi every time we need to pay our loans. And so our view then is that we need to be as close as possible to our customers, and hence our strategy to open, to double our bank branches. So this year we're opening 15 branches. I'm in Kakamega this weekend to open a branch there, and we're going to be opening another 6 or 7 branches before the end of the year. Already we're on the 7th branch, which I'm going to be opening. And we plan to continue on that process for a while. But these branches, however, they are really geared towards sales as opposed to service, because as I said, service will be mostly digital. It's more as a sales center, and that's what we're doing.
Okay. And then your aspirations or ambitions as NCBA, do you see yourself going heavy in the region, acquiring some banks, some smaller banks, and just, you know, expanding your footprint?
Look, I think first of all, to say that when you're third or fourth bank, your ambition is to the top. So we have every ambition to grow. And as we have seen, the growth of the Kenyan banks recently, the big ones have come from acquisitions cross borders. We are a creature of a merger ourselves. So we know how to do this, what it takes. So we will not shy away from the right opportunities. Are we looking to expand in the region? As you know, we are already in 5 countries, Kenya, Uganda, Tanzania, Rwanda, and Ivory Coast. Our entry in Ivory Coast is through a digital business, and we're using that as an entry business for a number of other markets that are under consideration. So you will see us certainly expand beyond the borders of the 5 countries that we're in. Will we do an acquisition anytime soon? We don't have anything in the horizon, but we don't shy away from looking at opportunities.
Okay. Is it too early to ask which country is next?
It's too early.